All eyes are on Ethereum, and especially the Ethereum treasury companies, right? This new idea of an Ethereum strategic reserve. This is where all the attention currently is. But the crypto markets work a little bit like a magician. There's all this attention over here, all this action over here, but what's actually relevant is happening in the background. This is where the magic happens. And so this current rally is actually not driven directly by the purchases through those treasury companies. The rally is driven by the narrative. The demand through the ETFs is higher than the demand through the treasury companies. And the demand through the spot market is even higher than that. Let's have a look at the Onchain matrix. Let's have a look at the data most people are not considering to try to figure out where Ethereum might be going from here. Because this is the first important chart. What we see in blue is how much of the supply is currently held by the ETFs, more than 5%. What we see in green, that's the holding of the strategic Ethereum reserve companies. That's only 3% of Ethereum's supply. And so since the purchases by the treasury companies are actually happening at a slower rate compared to the purchases through the ETFs, let's dive deeper into the ETF data. This whole narrative created a lot of excitement. Have a look at the spot Ethereum ETF volumes. ETF stands for exchange traded funds, so that's the vehicles that Wall Street uses to buy Ethereum via traditional means, like brokers. There was a bit of trading volume every now and then, but recently, since beginning of the month, this is exploding. This is in US dollars. It's a daily chart, and we now have more than 4 billion every day changing hands on the ETF market. Over time, ETH-A is gaining more and more market share. So that's the ETF by BlackRock. So this is the market share in terms of trading volume. Almost 70% is now in the hands of Gary Fink. And so most days we do see net inflows now, as in Wall Street as a whole is acquiring Ethereum constantly through the ETFs. This is the total on-chain net flows. And while this has been hovering around zero for a while, then there was a bit of purchases in the middle of December of last year. The purchases have now again accelerated since June, July of this year. What's interesting is how different ETFs tend to rally at different points in time. But the long-term trend is clear. So this is now the number of Ethereum that's held through the ETFs. The ETF did have a slow start, but now especially ETH-A is growing very rapidly. Without BlackRock, the growth wouldn't be that impressive. So really, this is almost entirely a BlackRock story. And so there are all those purchases through those ETFs, and since there are now also Bitcoin treasury companies, all other market participants tend to buy as well. And so the price is shooting up, thus the assets under management in those ETFs is growing much, much quicker. Right? This is now in US dollars instead of in Ethereum. There's more volatility, but there's also recently more growth because of the price appreciation of ETH. This here was the market share of trading volume. And here we've got the market share in terms of asset under management. We are not at 70% BlackRock yet, but we are at 44% with the tendency of this potentially further going up. Now, all those numbers don't really mean much if we can't put them into relation to one another, right? What does the ETF demand actually mean relative to the treasury companies, but also relative to the spot market? We've already established how the ETFs are almost double as important as the treasury companies, but have a look at the trading volume of the ETFs relative to the spot market. It went up, yes. Wall Street is becoming more and more active in crypto, but it's still only at 13%. So really the vast majority of price discovery does not happen via Wall Street money just yet. It's still the OG crypto investor with their self-custodied funds that make the real price discovery. And here's why I think so. Have a look at when the treasury companies really started buying Ethereum. The whole trend really kicked off on the 13th of June of this year. Here's the Ethereum market cap. The purchases themselves hadn't really changed the price that much, but the market cap since the treasury companies bought went up by 227 billion. Now, if you look at all Ethereum related entities, they hold 16.5 billion worth of Ethereum. When we look at all of the official treasury companies, they hold 11.5 billion. So it's 11.5 billion worth of real demand and worth of actual purchases versus a market cap increase of more than 200 billion. And so really, this is a narrative-driven rally. The Ethereum treasury companies are not as important as the Ethereum ETF, and the Ethereum ETF is not as important as the spot market. It's only 13% roughly. What's happening instead is that all the crypto investors get so excited about this new narrative that they just buy into Ethereum. The regular retail investor is now buying ETH in anticipation that there will be continued accumulation by those treasury companies, as we have seen with Bitcoin and Michael Saylor with its MicroStrategy. I think there's a real case to be made that Ethereum right now might already be quite heated. Have a look at the Ethereum market cap historically. We have hit the all-time high. From November of 2021 to July of 2022, Ethereum's market cap fell by 77%. And yes, there is a good chance we hit a new all-time high, but still, historically, we are already at quite high levels. When you compare Ethereum's market cap relative to all of crypto, yes, Ethereum had been higher before. The Ethereum dominance at one point was at 21%. So when we compare the entire cryptocurrency market cap and relate the Ethereum market cap to that, 21% is more or less the upper limit, 7% is the lower limit, and currently we are at 14. So we're not yet at a level where we should be absolutely under-allocated to Ethereum. But does it make sense to now have above average allocation after we've already doubled in dominance in the span of just 4 months? I'm not so certain. I've got the impression that Ethereum is really quite heated right now and that it can potentially drop a bit. Maybe there's another leg up, who knows? But right now the purchases have been so fast and the attention has been so high. Just have a look at the number of Ethereum search queries on Google. Retail is suddenly getting extremely interested in Ethereum again. Does it really make sense to buy when everybody looks at that token? Right? We want to buy when nobody is looking at something. We want to be like the magician, right? The attention should be where nobody is looking, and we should rather sell the thing where everybody is looking at that thing, right? There is a correlation between attention and price. Something that has very little attention tends to be low in price. Something where everybody talks about it tends to be very high in price. And it doesn't have to be talking, it can just be genuine interest as expressed here in the number of search queries. Now have a look at this. This is Ethereum relative to the smaller altcoins, right? Ethereum's market cap divided by the others market cap. So that's the market cap of the altcoins that are not in the top 10. And again, this is not necessarily that inviting of a purchase, right? Is Ethereum, relatively speaking, that great of a bet right now? My case here simply is that I want to be contrarian. I want to buy the things that I believe will stay relevant long term, but that are, comparatively speaking at least, rather cheap. And that is Bitcoin and Solana right now, in my opinion. Just have a look at the historical Bitcoin dominance chart. This also tends to move in a range. Here it is between 38% and 73%. Whenever we are close to 70%, we tend to see an altcoin or Ethereum rally. So that's when Bitcoin historically underperforms. But since September of 2022, Bitcoin dominance continues to rise. And we are now going down because of Ethereum's massive attention wave. But I do think there is a good chance that we will recover again, very similar to what happened in December of last year. Bitcoin, I believe, is very likely going to outperform Ethereum in the near future, simply because there's just too much attention and simply because the price appreciation, right, just in terms of market cap, has way overreacted to the reality, as in how much Ethereum is actually getting bought by those treasury companies. There's too much anticipation. There's too much front running, so to speak. Here's Solana dominance, and that also doesn't seem to be too expensive. There's a good chance that Solana could outperform the rest of the market by almost 50% from here. And here's the problem. There's just so much correlation within crypto, right? Everything is going up or is going down at the same time. For example, this year, everything went up, but during bear markets or during shorter periods of time, everything can also go down. So it seems like it doesn't even matter that much what kind of altcoin we pick here, right? It seems to matter more what's going on in the macro. Where is capital shifting? Does it make sense to study all of those white papers, to study all of those tokenomics, to study all the details and the founding team and the investors of all of those cryptocurrencies, when in the end they all go in the same direction at the same time anyways? I actually have a background in finance. I studied financial analysis and investment management in Hong Kong at HKUST. And over there, we learned about the concept of correlation within asset classes. This is not something that's unique to crypto. This also happens in the stock market. And there are quite smart ways to manage this actually. What we're seeing over here is now an example with the stock market. So in green, this fat green line, that's the Nasdaq 100. But then we've got these other squiggly lines, and they tend to move in the exact same direction at the same time, as we also see with the altcoins in crypto, right? The red line, for example, is Amazon. This pink line is Google. This purple line over here, that's Microsoft. So they all behave the same, even though the business models are really not the same. What I've learned in university is that there's a common approach called delta neutral investing. So we want to bet on an asset, but we want to take away the overall macro environment. We don't want to speculate on where the overall macro is going, if there will be a bull market or a bear market. We are just certain that one asset will do better or worse than another asset. So let's say, for example, here, we've got the Nasdaq 100 in green and we've got Netflix here in purple. And when the Nasdaq 100 is going down, then Netflix is also suffering and vice versa, right? Again, we've got all of that correlation happening. And we don't want to bet on the overall macro. We're just certain that Netflix will do better, for example, right? Let's just play with that assumption. What we then can do is we can go long Netflix and we can go short the Nasdaq 100. So since all the assets correlate all the time, once we go long one thing and short the other thing, we're suddenly canceling out the overall macro environment. So it doesn't matter if the market as a whole is going up or is going down. We are only speculating that Netflix in this example will do better than the rest. And suddenly, when we look at Netflix relative to the Nasdaq 100, we've got quite constant outperformance. And we can also at least get somewhat of an idea at what point in time Netflix might be cheap or expensive. So this is a completely market neutral chart. Just compare this with the Nasdaq 100, right? Those kind of moves to the downside or to the upside are not correlated with the overall Nasdaq 100 chart anymore. The Nasdaq 100 can crash massively while this relative valuation doesn't move much. So we're really taking away the macro. In other words, we don't have to think about anymore where the overall environment is going. Actually, now our idiosyncratic knowledge about a single asset can be turned into money without being exposed to whatever is going on overall. For example, let's say you've got the following thesis in crypto. You look at the different decentralized finance protocols and you think that Aave, as a borrowing lending platform, has a lot of growth. So this is the total value locked, or the capital that's in the Aave platform. It's growing quite a bit. And your bet is that Aave is better than, say, Balancer. This is BAL. This is total value locked of BAL. It's not growing that much. So your thesis is that because of that, the Aave token should also do better than the Balancer token. Here's the Aave price in US dollars. Sometimes it's going down, unfortunately, because the overall crypto market is going down. But Aave relative to Balancer is not going down that much. It's just going up. This is now on a logarithmic scale. Here's the same chart now on a linear scale. Isn't that nice, right? This is really constant growth. It looks much better than buying Aave directly, right? This is going up and up and maybe down, who knows, based also on the overall macro. And this is what investing is all about, right? We want to get the best risk-adjusted returns. We don't just want to make our 5 or 10x. We want to make this with as little volatility as possible. We don't want to crash 60, 70, 80% in the meantime if we don't have to. And there are ways, again, to mitigate the risk. We can cancel out the overall macro. And so there's another reason why Aave is doing so much better than Balancer. Have a look at the number of circulating tokens over time. This was at 13 million. And yes, over the years, over 4 to 5 years, this grew to 15 million. But still, this isn't really that much growth, relatively speaking, right? It's maybe 20% or so over the course of 4 to 5 years. But then compare this with Balancer, right? This started out at 19 million tokens, and this grew all the way to 69 million tokens. And that happened over a similar time frame. And so this is the perfect setup for a relative valuation bet. This is my preferred way to bet on any market, in crypto, but also in the stock market. The idea is that we don't want to predict where is the stock price itself going, where is the altcoin price itself going. We don't have to predict this because we don't know what happens with the overall market. Instead, all we need to do is we have to say, A is likely going to be better than B. And so we go long A, we go short B. And tokenomics, as in an expanding supply in the altcoin market, is always depressing many altcoins. Just have a look at the weekly issuance in the altcoin market that are here tracked by Tokenomics.ai. It's almost 1 billion every single week. If there's not 1 billion of additional demand for those altcoins every single week, then the altcoins go down. And so I'm following this strategy already for quite a while, roughly 4 years, and I've also opened a copy trading strategy 1 month ago. Now, due to high demand, unfortunately, I had to close future deposits, but it just goes to show how nice and constant we can make money with this approach. This is now annualized 74%. Yes, it's not a 10x every few months, but it's much faster growth compared to just investing in stocks or even Bitcoin and Ethereum for that matter long term. It's all about risk-adjusted return, right? The maximum drawdown here was 2.6%, while we are analyzed at 74%. So the premium members that signed up on time, they're getting exactly that return. But since the deposits are now closed, most people are now manually trading whatever I do. And so I try not to promise anything unrealistic. Most other YouTubers, they just say, here is the next 5 or 10x altcoin. But those altcoins, more often than not, they simply just come crashing down. I just try to compound the current wealth as quickly as possible without taking on too much risk. And yes, there is a slight learning curve to this, but it's all doable. All you have to do is watch 2 major videos using perpetual futures on Hyperliquid to bet on relative valuations, and then also, at least as important, risk management with relative valuation bets. Because again, you don't want to gamble with 50x leverage your entire portfolio and then lose it all. You want to constantly grow with little volatility because the venture capitalists and the insiders are dumping on retail constantly with their newly created tokens. This is how we make money. We put ourselves in the same shoes as the insiders. We make money like the insiders do. They dump on retail, we dump on most retail holders as well, because most retail holders just buy on spot and hope for the best and then lose in the process. They might not lose as much in the current market where everything is going up, but most people still, even in a market like this, do underperform just buying and holding Bitcoin and Ethereum. After you have watched those 2 videos, I'm simply sharing all my trades as I'm opening and closing them. And you can just blindly copy trade, but of course, ideally, I prefer if you continue learning more and more, because I do believe that crypto is not just a game of luck, it's a game of luck and skill. And the more skill everybody has, the more edge we can carve out of the market, the more money we can win against others. Premium is currently $125 per month. If you don't like it for whatever reason, just message me within the first week and I refund you 100%, no questions asked. If you decide to sign up even for the annual membership, then you will get priority access to the next copy trading pool. So I will open another copy trading pool at the beginning of next year, and all the annual subscribers will get access to that first before it closes, of course. A link to Premium should pop up directly over here on the screen. Just click on that. It will lead you to the website. If it's your first time here, feel free to subscribe. I publish this regularly. A like would be very much appreciated as well. It helps the channel grow. See you next time on YouTube or see you in Premium. Cheers!